For the 2021 Investment Strategy Annual, I helped co-author a section on the future of office with colleagues from around the world. Our piece shares views on the dynamics of office demand in the post-COVID-19 world and compares the impact structural headwinds from remote working could have on key markets. I would like to share a bit more detail on our office demand framework using the US as an example. While this focuses on the US, which is one of the most impacted markets, this framework can be applied to other markets around the world, with different assumptions often leading to quite different results. The first thing we consider in this framework is how common remote working was and how much that will change. In doing this, we need to understand the frequency of remote working per week for different groups. Working remotely 1 day per week means an employee is likely to still have an allocated workstation, while working remotely 5 days a week almost certainly will lead to no allocated workstation. Somewhere between those extremes, with people working remotely part of the week, firms are likely to look to adopt desk sharing or hoteling schemes that allow them to reduce the number of desks per employee and thus reduce space costs. Our outlook, which is guided by a recent Gensler survey of U.S. office workers, is for a considerable increase in remote working, both full-time and part-time to the level that enables desk sharing. The next assumption we need to make is how much space is required for each workstation. We start with an estimate of 195 square feet per workstation today, but honestly, the level that we choose today is not as relevant as what the change is going forward. We expect de-densification to lead that space per workstation to increase 5 to 10%. This is a boost for office demand and is largely, in our view, a backlash to the densification trends seen in the last decade, rather than a change due to increasing social distancing in the office. To get to the impact on market occupancy, we then need to consider the time frame for changes to be implemented. The length of office leases is a constraint on how quickly firms can adjust their footprint. In this analysis, we assume 7 years is needed for firms to phase in these changes. Then, we need to account for the long-term tailwind from economic growth and office jobs, or better said, jobs that would normally be done in office absent remote working. Here, we assumed a 1.7% annual rate of growth in office job growth, which is based on the pre-pandemic rate of growth in office occupied stock. Finally, there are short-term cyclical trends to account for. This impacts the pace and magnitude of near-term cuts and how quickly the market recovers. But as we look to the longer term, the impact of the near-term cycle dissipates. Putting all these assumptions together, we end up with an estimated decline in office space demand per office job of between 3 and 12%, which occurs over the next 7 years. In combination with the cyclical dynamics, this leads to about a 5% decline in office demand in the next 2 years before we start to see the market recover as the cyclical economic recovery takes hold. Based on our cyclical assumptions, a recovery to pre-pandemic total demand occurs between 2023 and 2025. Then, looking ahead 10 years, office demand growth is up in the range of 7 to 17% cumulatively, which is only about 50 to 75% of the pre-pandemic growth trend in office demand. Our first takeaway from this analysis is to note the wide range of outcomes from what we see as a relatively narrow and realistic set of assumptions on remote working. This speaks to the elevated risk to the office market going forward. We also recognize that differences in remote working and economic growth are likely to lead to a significant dispersion in outcomes across markets globally and even within countries. Ultimately, each of the assumptions detailed here has an impact on our outlook, and looking ahead to 2021 and beyond, we're eager to get more information to guide these assumptions, which will allow us to refine our outlook. Refining our outlook will provide more confidence in triangulating fair value for office assets and adjusting investment activities accordingly in what remains a highly uncertain segment of the real estate market.